why you should be a forex trader, and we highlighted so many points, 13 points to be specific, and you can see all the points on the screen why you should be a forex trader. We talk about how the richest man in the world, which is King Solomon, encouraged and advised us to trade financial markets. He said invest your money in foreign trade, and after some days you find profits. And then we talk about flexibility, how you can trade forex anywhere in the world as long as you have your device and then you have internet service and you can connect to the market, the global market. You can be accessible anywhere regardless of where you are in the world. You can trade financial markets. And then the next day we talk about liquidity, how there is always money in the market. And then we said you don't need a boss, you don't need an employee, you don't even need any office, your gadget, your phone. And I was telling this, I was giving an example of how I began to make a lot of money right from the corner of my room. Of course, now we have office, we have big office, and then we have even outlets, we have training center, we have institute in different parts of our country. And then, but then we didn't begin by looking for office or office space where we pay rent and the end of the month or at the end of the year. So you don't need office. Then talk about the risk control. Talk about that when you trade forex, you can actually control your risk. Any money you did not stake, the market will not take it away from you. So you can determine, okay, like for example, I was giving, like I also tell our students that you advise professionally to risk just 1% of your equity, 1% of your account per trade. And you tell them don't be on more than 3 trades at a time. Okay, just 1% of your account. Now talk about minimum investment. There's brokers around here. If you live in this part of the world, if you live in Africa especially, brokers allow you to even deposit as little as $5 into your account. And I always tell our students, I'm not saying you should begin trading with $5 your trading account. But when I started to trade at the beginning, just a long time ago, I didn't have all the money I wanted to start with. After I've learned, after I've tested, after I've acquired substantial knowledge, I wanted to trade. I didn't have all the money I intended to start trading with. All I was doing was to make deposit in bits, in little by little, until I was able to have substantial amount of money in my trading account and I started to trade. So what I mean is that you can even make minimum investments. People here can trade, you can begin trading with as low as $50 and $100 or $500. Then next to the point we raised last time that you have leverage. Leverage gives you is the opportunity that enables a retail trader to come into the market. Before year 2000, far back in the past, it was difficult for anyone to come to the market without having minimum of 100,000 USD. That's what you need to open the lowest lot size. But then with the introduction of brokers that give you leverage, you can come into the markets. That means, for example, if you trade with the leverage of $1 to $1,000, that means for every $1 you have, the broker can give you leverage, loan you $1,000. Now say we have unlimited profits. This is very spectacular. You see, if you acquire a lot of skills and then you are able to, you understand, you have a good grasp of technical analysis, you have a good understanding of fundamental analysis, and you have a good build up psychologically, and then when you have acquired all these skills in this area, it is possible to make a lot of money, unlimited profit trading forex, trading financial market. I've had students that made massive money within 2 months of trading. Of course, that doesn't happen for everybody. That doesn't happen. There are exceptional cases of students who have made a lot of money. I have students who are just undergraduate that we taught in our institute, and then they make a lot of money. It's very possible to make massive money, massive money. And of course, that may not happen for everyone. It's possible to have very limited profit, instant income. When you trade financial market, the market doesn't owe you. As you're making the profit, it's getting added to your account. You can withdraw it instantly, depending on the broker you use and which part of the world you belong. Instant income. You can trade forex as part-time or full-time. You can invest. There's nothing you do. There's no profession you are in that you cannot trade alongside with. It just depends on how many hours you're going to be spending in the market. Now we said no need for educational qualification. I was wild long time ago when I met a young guy who was just a secondary school student, and he was making as a then $100 a week. That means he makes $400 per month, over $400 in a month. Now, like, that is much more than what an average banker earns in a salary on monthly basis. That means what that therefore means that he is winning that not because he's making such huge profit, not because he had acquired certain educational qualification, he has BSc or BTech, like that, but just that, like I always say, market has its own language. What's important is that anyone who is coming to the market should understand that he's coming to learn. He should approach trading forex like I want to learn a new language entirely. And learning languages has nothing to do with how good you are or which school you went or anything like that. It's a new language entirely. You must approach it from the grassroots, from the alphabet, from the syllable. Then you now come into learn the sentences and the paragraphs and like that. You can trade anytime, even at leisure. Now today I want us to do something deeper. For some people who actually want to have a very strong foundation on how to trade Forex, or what I always love to call it financial market, because it's wider. When we use the word financial market, it includes a lot of other things. Now, what is Forex? Forex is just from the word foreign exchange. The word foreign and exchange. So the first three letters of foreign and the first two letters of exchange combined together gives us Forex. It doesn't mean FX. We do call it FX. That means you're trading, you're exchanging. Now this is what actually means forex trading. Okay, it is trading of one currency for another electronically. When you talk about forex, we are actually exchanging a currency for another currency, but we are doing it electronically. The different version of people exchanging currency for another currency. People do it offline. You can meet people at several different markets. If you are in this part of the world, people do that as a job. They do it offline. They exchange one currency for another. I've traveled to a few countries before that at the border you have to change the currency of the country we were coming from, the currency of the country we were actually landing. So and that's Forex. But this time around we're not talking about trading offline, we're talking about online trading of currency. So you exchange one currency for another currency based on certain factors that you have based on research, based on certain understanding you have. So you make a prediction. Okay, I want to buy this, I want to sell this, and that's what it needs to do. And that's what Forex trading is all about. It's about exchanging a currency for another currency. Now, many years ago when I came to understand who trade Forex and why, my life changed. I started making more profits trading Forex than I used to make before I came to understand who trade Forex and why. And ever since then, it has become one of the first things we train our students in our institute. When people come to the class, one of the first things we need them to understand, look, we need to have the right positioning of your mind as you come to the market. For example, we always tell our students, look, you are a retail trader. You're not a central bank, you're not a commercial bank. And I don't know, you as an individual, you're in a corporation yet, you may become that tomorrow, but you need to come to the market with the mindset, I'm a retail trader. Alright, now we trade Forex and why? Central banks. Central banks play the most active role in determining the exchange rate between one currency and the other. Very powerful. And you see, they are so powerful that they can even peg, no matter no matter how much a currency is growing against another one. Central bank has the capacity to peg the rate, the exchange rate. I'm going to be going deeper into that later on, and I'm going to be showing you why it is important for us to note this and understand it right from the beginning. Most people that lose money in the market because they don't really understand. you don't understand who trade Forex and why, you can literally figure out on your charts where banks are, where corporations are, where individuals are, where people are, where the big fish in the market, where they are located, and that will help you as a retail trader to make a lot of profit. I always love people to understand who trade Forex and why. You know, we're going to be going deeper into that when we get to our charts, but then let's look at it from here. Banks, commercial bank trade Forex. If you are in this part of the world, you're in Africa, you see, if you enter any of the headquarters, the bank headquarters, you will find out that they always have a department called Forex department, and they trade Forex. Now next to that is corporations. Big corporations trade Forex, come in financial market, put in money. Now, you know, sometimes it may even be in a different version entirely. Just imagine a very big company of a particular country that has a currency wants to go to another country to buy raw material. Okay, to buy raw material. Take for example, you know, a big corporation in Nigeria, Dangote for example, in Nigeria wants to go to Ghana to buy a raw material, and of course, you know, he's not going to be buying in 1,000 naira worth and or 2,000 naira worth. You're going to buy in let's say billions. So let's imagine a corporation like Dangote wants to go to Ghana to buy raw material and wants to buy close to, like, okay, let's say 25 billion naira worth. Definitely, when it gets to Ghana, it's not going to be giving them naira there. So when it gets to Ghana, it will have to give to the bank is 25 billion naira to exchange for the equivalent in cedis. And so when you get there and it's dropping, that means at that moment it's placing a demand on such huge amount of money, then Ghana cedis will, you know, there's a demand for Ghana cedis, then the price is likely to go up. When the price is going up, we call it bullish market. All of that it will relatively reflect on the charts that there's a high demand for this currency, and then it will affect how you're supposed to trade in the market. So corporations like that trade Forex as a move from country to another country doing their businesses. Now next to that, which I love the most, is a retail trader. I am a retail trader. I tell all my students, say, listen, let it sink into your mind, into your head, that you're a retail trader. And what do I always mean by that? The exciting part of it is that a retail trader, okay, is someone who follows trend. They say trend is your friend. And say a retail trader must understand he's a retail trader. At the moment he behaves otherwise, he will begin to lose money. Now, central bank, commercial bank, corporations, you know, they can determine the trend of the market regardless of the previous trend. Okay, a corporation can go, that is because of the volume of money being brought into the market. You see, because market goes in the direction of the volume, and you are a retail trader with your stipend, I don't know how much you want to have, I can actually determine the direction of the market. So you're coming in with $5,000, $20,000, $50,000, all of that is so sweet. Okay, now retail traders. Retail trader, this is where my attention and my interest always is. Retail trader. I always tell our students to never to forget and lose the consciousness that they are retail traders. A retail trader's behavior in the market is different from every other players in the market. Now, a central bank, commercial bank, big corporations, they can single-handedly determine the direction of the market, and that's why they bring in volume, a lot of money, and you know, market goes in the direction of volume. But retail trader with his stipends cannot determine the direction, so trend is always the friend of the retail trader. He can't change the direction, he can't change the trend. We must follow the trend to make his money in the market. So please understand that you are a retail trader. And you have to wait until you are able to identify the trend of the market before you enter your trade. And that's how to easily make money in the market. Now let's come here. Who trade Forex and why? I'm trying to give you a chart how the center, these are the people at the center that plays the major role. Central banks, they have the power to determine the market. Then next to them are major banks. Then we come to commercial banks. Next to commercial, then we have ECM brokers. Then last, which is last on the chart here, is the retail trader. All right, now Forex terms. This is where Forex terms. These are next training now. And I want us to look at these terms to give us a very strong foundation on trading financial market, trading Forex. Trading platforms. We're going to be considering candlesticks. We'll be considering pip and lot sizes. We'll be considering risk to reward ratio. We'll be considering take profit and stop loss. We will consider bull market and bear market. We will consider long position and short position. Now the first on that list is what we call the trading platform. Now there are several trading platforms, but for the sake of this training, we'll be limiting ourselves to MetaTrader 4 and MetaTrader 5. And this is where we gain access to the general market. You know, the market is not an offline market where you can go take your transport and get there, buy what you want to buy and sell what you want to sell. No, it's an online market. And what gives us access to the market are what we call trading platforms. There are several of them. Many brokers have their own special trading platform for their own company. But you see, the most widely used trading platform in the world is MetaTrader. MetaTrader 4 and MetaTrader 5 are going to be what we're going to be considering the most. And most of what we're going to be teaching how to use MetaTrader 4, MetaTrader 5, we're going to continue in the course of our training. Now, next to that on our terms, Forex terms, is candlesticks. Far back in the past, at the beginning of trading financial markets, traders were using line charts. A line chart was metamorphosed to bar chart, and later to candlesticks. Candlesticks is the most recent, most detailed, and most effective market language in trading Forex market. And so you can have people, some people still use line chart or bar chart, but trading with candlesticks is the best for me as a person, and it has made life very easy. Easier to understand the market. It tells something deeper, you know. Now, these are candles on my screen. These are candles on my screen. You have a candle with the body. You have a candle with the wick. The upper part is called the wick. That means the price was once here, and then the lower part is also called wick. This is the whole body. Then we have the open price and closing price. Means you have we have like two colors of the candle. Color is not what actually matters. Is where the candle opens and closes that actually matters. Okay. Now these are the candle looks like. And then we have the price on the right. And then we have the candles on the left. The price is usually by the right, and that tells us the price movement. The candle actually helps us to know a certain period of time where was the price, where for that period of time where the price opened, where the price closed. Now time frame is very important here. On this screen I'm really with the time frame, but whatever the time frame is, we know that the blue candles tells us that the closing price was above the opening price, and then the red candles, which we usually call the bear candle, is that the price closes below the opening. How do you differentiate between the bullish candle and the bearish candle? It is not by color. Anybody can use any color you want. But knowing fully well that the candle is said to be bullish candle when the closing price is above the opening price, then the candle is a bullish candle. Now, the opposite is for bearish candle. For example, as far as this screen is concerned, these red candles are bearish candles. It therefore tells us that the closing price is below the opening price. For example, look at this candle on my screen now. The price opens here because the previous candle closes here. Usually, the opening price is usually the closing price of the previous candle. So as this candle closes here, the new price opens immediately a candle closes, depending on the time frame. So if these candles are, if this chart is 1 hour chart, that means it takes 60 minutes for each of the candle to be formed, and it therefore tells us the price action, the price movement in each of 1 hour, in every 1 hour. So now we see that now for here now, for the blue candle, which is the bullish candle, the closing price is above the opening price, and for bearish candle, the closing price is below the opening price. Now, if you come back to the right hand side here, you'll find out that the price is written here, and we are having 4 decimal places. 4 decimal places. Now, the fourth figure on the 4 decimal place is called a pip. It's called pip. It's getting clearer here now. Look at it. 1.4001. This last one is called the pip, where the fifth figure is called the pet. For example, if you look at our charts, which I'm going to be showing you later, you discover that there are usually 5 decimal places, except for currencies that have or PAs that have Japanese yen. Okay, that one ends with 2 or let's say 3 decimal places. Here now we have 4 decimal places, and we have the 5th figure to be prepared. So that means if there's going to be an increase in the price move from 1.4006, if price move from 1.4006, that means price has moved by 1.4006 minus 1.4001, and that means price has moved by 5 pips. 5 pips. There's a 5 pip movement. Now let's look at it further. Now let's look at it from here. Let's assume the price. Let's assume that this price is opening at 1.4007. Let's assume for easy identification. Let's assume this price is opening at 1.4007, and then it's closing at 1.4077. And let's assume that this chart is 1 hour chart. So between the opening of the price and closing of the price, how many pips has the price moved in the bullish direction? That means 1.4007 minus 1.4077, and that's 70 pips. That means within this time frame now, the price has moved by 70 pips. We have 70 pip movement in the bullish direction. The price has gone up by 70 pips. And now, another thing I want you to understand is the currencies are usually written in pairs. For example, we have Euro USD, which is the most traded currency pair in the world because it represents the most powerful economies in the world. Now, here's the point. So we have Euro USD, then you have USD JPY. They are always written in pairs. We're going to be showing you all of that later. But I want to show you something right now. The one by your left is always called the base currency, and the one by your right is always called the quote currency. That means we are using the quote. We are using the one on your right to quote the one on your left. The one on your left usually having a value of 1, and the one on your right is we use it to quote. That means as what you see on the screen right now, it means for every €1 you will need 1 this is how the currencies are written in here. You have USD, CHL, which is the first two letters usually represent the name of the country, where the last two is the third letter tells us about the currency of the country. So when you have USD, US means United States, then the D means dollar. CHL, that's Swiss franc. F there is represent the franc, that is the currency spread. Then we have GBP, Great British Pound, pound is the name of the currency, where GB represents Great British. Then we have some exceptions like Euro and a few other exceptions. Let me show you when we get there. Then we have JPY. JP means Japanese. Then Y means the yen, Japanese yen. Then you have CAG, that's Canadian, and P means dollar, Canadian dollar. You have AU represents Australia, that's GDP dollar, Australian dollar. Then we have NZD, New Zealand dollar. Before candlestick was being used as market language, there were two other languages that were being used before then. Now look at it, this is what we call line charts. Years back, this is what traders were using to determine when to buy or when to sell in the market. And after line charts came the bar chart. The bar chart looks like this. It is more detailed than line charts. But all these are not our interest. Our interest for this course is the candlesticks. The candlestick. Look at how bar chart was, then look at how the candlestick is most detailed of the three. Is easier for you to understand as a trader, and you can master the candle analysis, the candle pattern, the candle analysis. Especially then you master the price action. You'll be able to make profits just looking at the candle. Look at the candle. When the candle is big, it has its own meaning. When the candle is small, it has its own meaning. Now, on my screen then we have green candles, we have red candles. The red candles are telling us that the market, the price is going down, while the green candles telling us the market, the price is going up. So the green upward movement is called the bullish candle, and the red downward movement is called the bearish candle. Now, what matters is not really the color, because as a trader you can choose any color you want. I don't want people to get addicted to the colors. Oh, it's green. Oh, it's red. Oh, it's blue. That's not what matters. What matters is that when the candle is opening, when the candle is closing. Now, when the candle, for example, look at this candle. This is a green candle, followed by a green candle, followed by another green candle, followed by this green candle. Now, this is the end of the green candle. That means the price was moving like this, and the price ends here. The end of this candle is the beginning of another candle. Now, the price didn't continue moving up. The price was moving up. So every time the price closes below the opening, the color will go red. Based on the setting on this computer, the color will go red. That means the price is coming down. Now, this one closes here, another candle opens here. And as long as the price was coming down, the color remains red. So therefore, what happens is that when this candle opens at a particular time, this is 1 hour time frame, at a particular time in this price movement, price went above the opening. That is what this week signifies. That means at a particular time the price was there, at a particular time the price was there, at a particular time was there, but later on it was going lower than the opening. The moment it comes this way, the moment it goes lower than the opening, the color changes to red. All the time the price was there, the color was green, because it was above the opening. The opening price was here. The opening price was here. Let's check the opening price. The opening price was 1.19220, and at